Investor Intelligence provides general information only. You should consider seeking independent advice to see how this information relates to your unique circumstances. Please refer to the terms and conditions available at investorintelligence.com.au for more.
Welcome to this week's episode of Investor Intelligence, your weekly podcast on all things investment, hosted by me, Jacob Kearns. With me today is a fantastic guest we've had on the podcast many times before. He's a property expert who's quite literally wrote the book on property investing, not just one, in fact, but two books and possibly a third one on the horizon, Luke.
Possibly underway.
But I realised we've never actually done a deep dive on your story and how you've managed to get into the position you're in today. And I think for a lot of our listeners who are wanting to grow wealth, whether it's through property or anything else, it's so valuable to listen to how someone else has done it. So I want to discuss your journey, the things you've done right, and of course, the mistakes you've made along the way. So once again, welcome to Investor Intelligence, Luke Harris.
Thanks, Jacob. Good to be here.
So let's start with your own property investing journey. How did you get started, and where has it taken you, and where are you now?
Well, it's quite a long story spanning over the last 23 years or so, but how I got started was essentially running my own business, running an electronic security business in Perth and saving a deposit, working 7 days a week as a 18 and 19-year-old saving a deposit, running my business. I had staff that I was paying and it was quite a busy life for a 19-year-old. Saved up a deposit, got into my first home in Perth in 2000. And I did get some help with my parents going guarantor on the loan because I was self-employed. I couldn't get a loan on my own, so they had to go guarantor for me, which they were happy to do. And yeah, since then, I settled on that property. I've gone out there and I did what a lot of people did, was just go out there and buy a property that they liked. I lived in it. And then after that, my next purchase was something that, yes, I did what I thought was research and found an area that I liked, went and bought it. And then from there, I read books and magazines and DVDs back in the day and listened to basically anything I could. Podcasts weren't really a thing, 20-something years ago. And you couldn't really get YouTube videos and blog posts the way that you can now. So it was really a lot of property magazines and books that were out at the time. And I guess from there, I was just doing what a lot of people do, is just go out there and find the next best property when I was ready. And there wasn't really much planning involved in that. So how I got started was, like a lot of people, is just buy what I could afford in an area that I liked. And I guess that's not necessarily the best way to invest, but it got me started. Where it's taken me over the last couple of decades is, it's taken me on quite a journey, actually. I have made a lot of mistakes. I've done a lot of things right, but I've also done a lot of things wrong, or things that I could have done better. I've never lost money on property, but I've certainly made some poor decisions, and I've learnt from that. But where it's taken me over the last 20 years or so has been an incredible journey, and a lot of learning and a lot of lessons along the way. And I guess now running the Property Mentors has given me the ability to share, I guess, my experience investing in property, the good, the bad and the ugly, and really to show other people that there's more than one way to make money through property. And a lot of people have a misconception that there's only one way to do property. And, a lot of the time people, I want to be a developer, or I want to do renovations, I want to do subdivisions, and people get their head sort of stuck in one train of thought in how they do property. But where I'm at now, I'm in a very, very great position in my life, very fortunate to have had some really great advisors along the way and had some really, really good experiences with property and watching property markets and cycle through different interest rates, different governments, and yeah, it really is a fantastic journey, and I do treat it like a journey. It's not a destination. It's not something that you just stop doing. For me, I'll be investing in property for quite some time to come.
Yeah, that's awesome. And I know your business, The Property Mentors, you've been operating for 9, nearly 10 years now, and you're helping investors avoid those mistakes that you made when you first started. I do want to sort of dive into what your portfolio looks like a little bit now. And you mentioned as well that there's not just one way to invest in property. There's multiple different ways. So what does your portfolio look like now, and the journey it's sort of been on to get to this, and why you went this particular direction with your investing?
I guess if I break down my portfolio into two separate periods, really, the first 10 years was doing what a lot of investors do. Like I mentioned, is going out there and really taking a bit of a zigzag approach. I was in my 20s, so the first 10 years of my investing was literally from age 20 to age 30. And during that time, I went out there and I was reading books and magazines, and like I said, I was just absorbing as much as I possibly could. Probably like a lot of people listening to this podcast, actually, just listening to, I guess, all the free stuff out there to try and work out which really fits in with my situation. And I was going through, I guess, learning what I could, and every now and then there would be an expert out there that would talk about buying in mining towns. And there's people that are buying cash flow positive property only. Don't look at anything else unless it's positive cash flow. There's people doing renovations, and I'm not going to name names of all these people, but, there's certain experts out there, they're not doing it anymore. But at the time, they were big names in property that were focused on certain ways to build wealth. And so for me, the first 10 years of my investing was really a zigzag approach, because after my first house, I went and bought an apartment in Perth. And then after that, I went and bought in a mining town because I thought positive cash flow was the only way to invest, after I'd spent some time learning more things. And the thing that a lot of people sort of think about is that they're not buying a property every year or every 2 years. So often there's a gap of a year or 2 or 3 or 4 years before they buy their next property. So that's a lot of time in between purchases to really think about what your next one's going to look like. And so I was going out there and reading all of these things and learning, and I thought, well, this expert says I should buy in mining towns. So that's what I did. After that, I had a bit of a break and saved up my next deposit, and then I needed to do renovations because I'm pretty handy with the tools. My work was based on building sites. I worked in electronic security, and I was on the tools out there, and I knew how to climb a ladder and operate a drill and do all of the fun things. So I loved doing hands-on stuff. So I thought, well, I can do renovations. So I did a bunch of renovations, and then I thought, well, there's more money to make in doing developments. So I learnt about being a developer. And so I went out there and did some subdivisions and did some unit developments and did a lot of these things. And then I bought off the plan, because I thought, well, buying off the plan in a rising market, you can make some money on the way in by buying off the plan. And in Victoria back then, in 2009, they had stamp duty concessions. So you could buy an asset off the plan and you could save an absolute fortune on stamp duty. Now it's been abolished. You can't do that anymore. I did that a few years ago. But back then, the stamp duty on a $700,000 purchase was only $5,000 or $6,000. So it was a really good chance to get a nice, good quality blue chip asset and pay little to no stamp duty on it. So really going from renovations to mining towns to developments to subdivisions to buying off the plan, I pretty much put my finger in all pies. I was trying all of these different property strategies in the residential investment market. And I guess to summarize, the first 10 years of my investing was very much like a lot of investors, because I was really just chasing the next shiny object that was out there. I didn't really have a plan, and I was buying properties on an ad hoc basis based on what I thought was good at the time, based on what I could afford at the time. But the underlying lesson from all of that was that there was no plan. My plan was, in my 20s, naively, I just wanted to get rich. And I thought that getting rich was just by buying a bunch of properties, and one day it will all work out. So I had this little moment when I had started a business when I was 25, and I sort of sold that business when I turned 30. And I took what I call my little mini retirement. I took 18 months off, sold the business. I actually sold another property as well. So I had some cash in the bank and moved back to Perth for a little while, and had a bit of a break over there and hung out with family. But during that time, I really started to work out what investors do right, what investors do wrong, what I'd done right and wrong, and what I could improve on, and really sort of mapped out a process for me to really plan the next 10 years of my investing.
Okay. Yeah, I think it's hard when there's so much information out there, right? Like you mentioned, or the expert talking about different methods to grow wealth, and they might not necessarily be wrong, but it depends on what's right for you in your particular situation, your finances. Can you explain a little bit how property is more individualized, tailored to the investor, as opposed to maybe like other asset classes such as stocks or bonds or whatever it is?
Well, look, I guess for me personally, the lesson that I took from that was understanding that regardless of what you're investing in or how old you are or anything else or your income levels or anything like that, all investors need a plan. And we're not talking about a financial plan that you get from a financial planner. We're talking about a plan on how to really build your life and you're investing at the same time. I've always had this view on life and in investing is that you don't put all your money into investments to the detriment of your lifestyle. I've always continued to travel. I seem to have an obsession with buying cars. I've probably bought in the time that I've been able to buy cars. What's that? A good 26 years or so since I turned 17. That's a big number now that I think about it out loud. I've probably had as many cars. I have wasted so much money on cars, and I've got some fantastic cars now. But it's just a kind of a hobby. It's something that I love driving. I drive manual cars where I can, and I guess from that, it's about getting that balance between investing and living your life. So I've continued to travel. I do travel every year, and I drive nice cars. And these are things that I guess a lot of people sort of don't really understand getting that balance right. And so when you're talking about your overall long-term plan, it's about getting that balance between what you're investing, what you're spending money you'll never get back, and how you balance your investing and your lifestyle. A lot of people they say they want to go and buy their owner-occupied property because they want to live in that property. So look, I'll get my owner-occupied property first, and then I'll do my investing. But for most people, what happens is they get the owner-occupied property. It's not a tax-deductible property. They end up paying that mortgage for a bunch of years, and they have kids, and life gets in the way, and then they never invest. So I think regardless of what you're investing in, it comes down to the fact that you do need a plan, and that plan really needs to match up with your long-term goals. And I think for most adults, we actually don't learn at school or from our parents how to set goals, and we don't know how to work backwards from those goals. So really that's how the Property Mentors was established. And when I took this 18-month little mini retirement, I actually set the foundations for this business so that we can actually teach people how to set out their plan first, how to set goals and work backwards from that, and then match up second to that, match up the property strategy to go with that. Because during my 20s, like I said, I was going out there buying a bunch of properties with no plan, and the ultimate goal was just to make money. And that's a very high level goal, but it doesn't have enough detail in it to help make good financial decisions. And so once you actually have that plan in place, you can make decisions based on your goals rather than just look at the investment on its own.
So what made you start the Property Mentors?
Well, I think, look, during my 20s, I'd actually helped a number of my friends and family and colleagues, and people would come to me frequently knowing that I was out there in the property space, and I never shut up about property, and that's never changed. And so I was always talking about property and family events, and I got my family and my parents and my sister and my brother have all invested in property. And I think for me, it was really looking back at what I'd done when I had that break. I looked at what I'd done and said, how do I actually get into the property space full time? Electronic security was a changing industry. It was when I started, when I was 16 or 17, it was basically running cables and plugging things in. But as it got through the 2000s and mid 2000s and late 2008, 2009, it sort of became a point where electronic security was merging with IT. So everything, instead of just plugging a cable in, it was Cat5 cables, Cat6 cables, and plugging things in, and IP addresses and computers. And I was never really good at computers, and I didn't want to go down that path. So for me, selling that business was a good time for me to get out of that industry. I knew I loved property. I knew I loved helping people invest in property because it had worked for me. And when I sat down and went through that process, it was really making sure that if I was going to go into a property investment business to teach others, I didn't want to be like every other property company that was out there. And what that means is that there are a lot of companies out there in the property space, and many of them have come and gone over the last couple of decades. They've just They appear, make massive big claims about how you're going to get rich overnight, and then 2 or 3 years later they're gone again, because it doesn't work that way. Property is a long-term investment. And so for me, mapping out how the Property Mentors was going to operate was around the long-term nature of investing and teaching people that you need patience rather than just going out there and expecting to make a quick buck. Now, I'm not saying that you can't make a quick buck in property. It happens. It can happen. And for some people, absolutely, they will make a quick buck out of property. What I wanted to do and still do is to teach people that if you get the fundamentals right and you understand the long-term nature of investing, you can minimize the risk of your investments, but also enjoy your life at the same time. Have that work-life balance. Have that balance where you can still go out there and have holidays and do things with the family and not have to worry about just funding your property portfolio every month. And so looking at how the Property Mentors was going to be structured, it was really on mentoring rather than selling property. Whereas a lot of companies out there, their focus is to sell property and just move on to the next person. We wanted to really build relationships with our clients and with our members. And that actually means that it's a two-leveled approach, is that the member that is working with us has a great result because they're building a relationship with an actual mentor. That means that if they want to go out there and invest over 2 to 5 years or more, they can learn about the marketplace. We'll educate them on their plan and their strategy and work with their expert team. But also they don't have to go out there in the marketplace every single time they want to buy a property and find somebody else to go and work with again. So basically having a mentor on your side. The benefit for us as a business, of course, is that by having members that want to build a long-term portfolio, we also as a business don't need to keep going out there and finding new clients all the time. So it's a win-win approach, and that's a great way of doing business. And that's what we've done for the last decade or so, is to really teach people that the long-term, I guess, slow and steady wins the race. Yeah. The long-term approach to investing has worked for me, and it does work. The hardest part for most people is being patient, really.
Yeah, and I think because there's so many different approaches to property, there's so many different companies with their own niches advocating for their different approaches. How does the Property Mentors, what's your niche besides what you just mentioned with coming up with a plan, long-term investing? What's the Property Mentors niche, and I guess who is the best suited client that you work with?
I think the first part of the question, obviously, our niche really is that we're focused on the investor first and foremost. Now, there's plenty of companies that will specialize in doing renovations, or that specialize in teaching you how to be a developer. There's NDIS properties. There's all sorts of different specialist companies that do those things. And look, there's certainly nothing wrong with those concepts. I'm not saying that the companies themselves are right or wrong, but if somebody's suggesting that you do a specific strategy only without factoring in your goals and what you're trying to achieve, then run a mile. I mean, why would you work with somebody that doesn't want to understand you as the investor? So our niche really is that we understand the investor first and foremost. We need to understand, before we can start working with anybody, what your goals are, what you're looking to achieve, what your financial capacity is, what's your risk profile, what's your experience in investing. You might have done some investing in other areas before. You might have put money in Bitcoin or the stock market, or you might have bought some other investments. We need to understand all of these things first so that we know what type of investor you are. And in my first book, Let's Get Real, we summarized the investor profiles. So there's a full description of all of the different investor profiles. It's really helpful for people to actually go through that and read what type of investor they are, because the type of investor you are will determine how you make your decisions. And, there might be some things that you need to, I guess, unlearn. You might have learned some bad habits. So we really focus on the investor, make sure that you have your mindset right and you do have the education that you need first before you go out there and put your hard-earned money into the marketplace.
Yeah, and it's so important, right? Like, everyone wants to make money and just get out there and invest, but without having a clear understanding of your goals and what you're trying to achieve, it's really, you're shooting in the dark almost.
Well, yeah, a little stabbing in the dark, I think.
Whatever they're saying.
But, I think at the end of the day, you're 100% right. And this has come through from my own personal experience. What I was doing in my 20s was just going and buying a bunch of properties. And I bought and sold properties, and some properties that I sold, 15 years ago, I wish I'd kept them. I should have kept them, but at the time it gave me some money to do some other things which I thought were better options. So really, when investors are going through this, it's like anything you haven't done before. If you haven't built a multi-million-dollar property portfolio before, and knowing how insanely important it is to get it right, like this is not something that, let's give investing a go for 10 or 20 years and see if it works out. 10 or 20 years goes by, you can't get that back.
Yeah.
So if you understand the importance of it and how it can massively change your life, if you get this right and you invest properly and you have a great team of people around you, accountants, financial planners, mortgage brokers, solicitors, and a property mentor by your side, you can build an insanely successful property portfolio. And you don't need to have a huge 6 or 7 figure income to do that. We've got a lot of our members that have been working with us for years that have started with very, very basic incomes, and they've managed to just do what it takes to build a portfolio. And it's super exciting for us when we help people to get that education, to get out there in the marketplace and, get the advice that they need from all of the experts in their team to build something for their future. And getting it right is so crucial to your success. And just going out there and doing something, I always link it to flying a plane. So you might sit there on Google trying to research the best place to buy a property, but it's sort of like flying a plane. There's a lot of things you've got to learn. It's not just about taking off and landing. It's all the things you've got to do in between. You've got to do all sorts of checks and balances before you take off, before you get out there in the plane and turn the switch on. You've got to check your fuel levels. You've got to check the wind. You've got to check your weight loadings, your passenger levels, all of these checks and balances you have to do to make sure that it's a safe journey. Once you take off, there's certain things that you've got to do. You've got to turn certain things on. The autopilot, I imagine, is pretty important. But also there's sort of things you've got to put the wheels up, and you've got to do a whole range of other things to stabilize before you go into cruising altitude. And again, when you're going back to land, which is, I guess, linkage to your retirement potentially, is that, there's certain things you've got to do in preparation for landing. All the tray tables have to be up. Everyone has to be seated and put the seatbelts on. And of course, you need to make sure that you're checking weather conditions and so forth, and make sure that there's no other planes on the runway and things that you could crash and burn at the other end. And this is the simple analogy is that, when you look at it like that, there's no point in learning how to land if you haven't learned how to take off. So it's about doing things in the right order. And if you haven't done it before, learning from experts like the property mentors means that you're going to get experienced people that have been there and done that. And not that we've just done that, it's that we're actually in the marketplace buying property every year. So most individual investors will only buy a property maybe every 2 or 3 or 4 years. Maybe if you're buying lots of property, you might buy a property every year. But for most people, they're only buying a property every couple of years. At the Property Mentors, we're buying properties every single week. So we are in the market, on the ground, buying properties every single week with our members. And that means that, we've got our finger on the pulse probably more than anybody else. We do the research and the due diligence to actually make sure that we are across all aspects of what's going on in the property market. And we're across all of the finance options, changes to accounting and financial planning, because we're always, every day we're speaking to our expert team. We're across all of the changes and we know what's going on. So I think, long answer to a short question, but really it is a great business model that genuinely helps people.
Yeah. You mentioned you started out investing in residential. How did you progress from residential property to commercial and then developments? And I guess what advice would you give someone wanting to go down the same path?
I guess everyone's path is going to be different, but to go from residential into commercial and doing developments, I guess it was done a little bit by chance. My first developments were not really part of a plan. The issue that I've got, first of all, with development, a lot of people want to be developers because they think that it's going to be faster cash, or they're going to build wealth faster. A couple of points on that. In my second book, Property Fit, it was launched earlier this year, was really around the fact that being a developer carries a huge amount of risk, in that if you're going out there to be a developer, a lot of people think that the best way to start that journey is to get into doing, 3 or 4 townhouses or maybe a duplex development or something like that. The problem is that getting into a development of that size is probably one of the most affordable ways of getting into the development market. If you want to be a developer, well, obviously the cheaper end of the market is the safest in most people's eyes because they're not putting too much capital in. You're buying a block of land for $1 or $2 million and you're chopping it up. The problem with that is that's where 90% of developers operate.
Right.
In that smaller market where you're looking at, $1 or $2 million development sites. Even if you're spending $3 or $4 million, it's still a highly competitive market. What that means is that every wannabe developer out there is competing for those same properties. And when there's more competition, right, what you'll see is prices will increase. People will outbid each other because everybody wants that slice of the development market. So because of that, people are bidding up the price of the development land, which means the profit actually reduces every time somebody puts a higher price in. And often the smaller the development actually can get more complex because it takes just as long to get 2 or 3 townhouses approved as it does to get 10 or 20 approved. Okay. Problem is for most developers or wannabe developers, they can't afford to spend $5 or $10 million on a piece of land and do a development of that size. So when you're talking about getting into the development space, a lot of people think that's the way to build wealth when in fact most people are trying to do that. And you're also competing with builders. Now, if builders are not busy, they'll go out there and buy a piece of land. They'll develop it themselves because they want to keep their trades employed and they want to keep their good trades. So often, and I know builders that do exactly this, when the market cools, and I know a few years ago they were doing this, they were going out there and buying 2 or 3 unit development sites, knocking down the house, putting 3 townhouses up, and that's how they would cash flow their business and stay in business. Now, if you as a developer are going out there to do a small development, you're probably going to hire a builder. The builder's going to have a builder's margin, and you as the developer need to put your profit on top of that. Now, if a builder is already going to be buying the site themselves, they don't need necessarily the development profit or as much development profit. They just need their build profit that they were going to get anyway.
Right.
So they can pay a little bit more for the land, and therefore people are bidding against builders. Sometimes you don't know. You're bidding against a builder, and all of a sudden you're paying too much for the land. You end up with a development that makes no profit. So these are things that people don't factor in. And again, this is through our experience. We can explain these stories to people is that, sometimes it's better off waiting until you've built a successful property portfolio first. Build your asset base first. Banks and lenders, especially for developers, they want to see a nice, solid, stable asset base, such as a property portfolio that's bringing in income, that's got plenty of equity in it, that's nice and stable. Right? Banks love that. And then if they know that you've got that, they will lend you money to do developments and proper developments, multi-million-dollar developments that in fact bring the risk down because there's less competition in that space. So for me, that's my view on investing as a developer. And the other point to mention there as well is that being a developer is for cash flow. Okay, because obviously developing property, you're buying a piece of land, chopping it up, putting some houses, townhouses or apartments on it, and you're selling them all. When the money comes in, you pay tax on that income, and then you've got cash flow coming in. So that's not long-term wealth creation. Depends what you do with that money, of course. But when you have that income, you don't have the property. So a lot of people are developing property. They sell all the properties. They might make some money. They might lose some money. If you make a profit, you pay tax on it, and then all you're left with is money. You've got to deploy that capital somewhere else so that you can continue to grow that. Whereas if you just buy properties and hold on to them, over the long term, they'll grow in value. The other part to the question was getting into commercial property. My first step into commercial property was buying the premises that I operated my business from, and have done that a few times as we've moved and grown the business, and have also bought some other commercial property along the way as well. But those have been more strategic decisions to fit in with the portfolio, and I guess knowing when and how they fit in to the portfolio rather than sort of just buying them on an ad hoc basis. So in the first 10 years, like I mentioned, I was very ad hoc approach to my investing. That was all residential. The commercial properties in my portfolio have been very deliberate decisions to balance out the portfolio.
Do you have a plan on investing in other asset classes?
I do have investments in other asset classes, generally for fun, to learn a little bit about the stock market, learn about other investments. I don't own any cryptocurrencies or Bitcoins or anything like that. But yeah, I have done other investments as well for fun, but property is my core investment strategy.
So how do you see your investing career evolving as time goes on?
I guess where I'm at with my investing now, it's sort of at quite a mature phase of acquisition cycle. evolving as such, I'll always continue to invest in property. I love property. There's always opportunities in every market. A lot of people think, well, interest rates are going up, so I shouldn't invest. Actually, what that does is it takes people out of the market, which is a great time to invest. So you do the opposite to what everyone else is doing. So a lot of people don't understand that. For me particularly, I'm going to be looking at opportunities over the next 5 to 10 years in the growing capital cities. Now, what I mean by that is places like Perth, Brisbane and Melbourne. Melbourne in particular has insane levels of infrastructure spending. And a lot of people sort of underestimate the value that that's going to bring. Melbourne in particular is going to be the biggest capital city in the country. It's very borderline with Sydney at the moment. There's only a small number in between. I've been saying this for a few years now that once Melbourne finally overtakes Sydney in population size, there's no going back. It will never go back to Sydney being the most populated capital city. Whether you love Sydney or Melbourne, I'm not anyone listening to this. I'm not having a go at Sydney, and I'm certainly not, picking sides here. I love Sydney as a city, right? But Melbourne has a plan for growth, and it's actually working very, very well. They've got a very good range of policies around infrastructure spending, but also population growth, transport infrastructure, even things like expanding the airport, trains to the airport, all of these things that they're doing. All of these projects that are happening in Victoria really are, putting a positive spin on the market. But also Brisbane and Perth are going to continue to grow, and they're attractive cities to be looking at over the next little while. So, look, I'll be continuing to watch markets and taking advantage of opportunities as they come up. But like I said earlier, I love doing what we do here at the Property Mentors because it allows us to genuinely help people that want to be helped. Unfortunately, I can't force somebody to educate themselves on investing. There's plenty of people that are going to go out there and try it on their own and learn the hard way. But yeah, for me, there's a lot of opportunities here in the Australian property market in the next 5 to 10 years or more.
Yeah. I don't understand the rivalry between Sydney and Melbourne. I mean, who cares?
Well, I guess it's always been there. It's probably not going to go away. The reality is that, it's certain people see it as a serious thing. Certain people, take it with a grain of salt. But the reality is that Melbourne is a growing capital city, and it will overtake Sydney in population growth. And I think the reason for that is because Melbourne has gone out of its way to actually do planning around that growth and has done specific things to attract not only interstate migration, but overseas migration with a lot of focus on education, universities and so forth, and has done a lot of external work to attract people, but also the planning in place for accommodation. And, everybody knows that Sydney is a very expensive place to live. Melbourne still has a lot of affordable options. It is still becoming a very expensive city, but there is still affordable options available in Melbourne, which just seem a lot harder to get in Sydney. And I think the part of the reason for that is that Sydney, for whatever reason, hasn't been planned as well as it could have. Melbourne has been planned, with the Hoddle grid being designed in the CBD many, many years ago. Well, if you look at the aerial view of Sydney CBD, and then you look at an aerial view of Melbourne, Melbourne's got what's called the Hoddle grid, and it's called the Hoddle Street grid, where Melbourne's CBD is arranged into a grid pattern. Nice, clean, straight lines. If you look at the CBD in Sydney, there's zigzags and lines everywhere, and it is actually quite a funny map when you look at Sydney versus Melbourne. There's quite a funny meme actually. If you look up, if everyone wants to laugh, I'm not going to use the swear words in it, but Sydney versus Melbourne meme. If you look that up online, you'll see the thing that I'm talking about. It's actually quite funny because it compares the two capital cities. And Melbourne's Hoddle grid really means that Melbourne from the outset was designed purposefully and had a very, a formal approach to its CBD. And that's actually extended out into the suburbs as well. And Melbourne from a very long time ago actually had, mini CBDs outside of the city. And with the world's biggest tram network here in Victoria, it just means that access to public transport, these mini CBDs, and the planning around that has meant that Melbourne has the ability to do infill developments and basically provide more affordable housing. Nothing against Sydney in this sense, but Sydney's got this big, beautiful harbour that Melbourne doesn't have. And that's actually caused a lot of issues for Sydney's growth because anyone in Sydney that seems to have some money has bought near the harbour, meaning all the expensive houses are all based around the harbour to capture a little bit of that harbour view. And that's not just in one area, it's around the entire harbour, which is not just in the CBD, but it continues along quite a large area, which means that a lot of expensive areas are based around the water, and there's a lot of water. And of course, then you've got the beachside suburbs as well, and all those beachside suburbs are super expensive. So then you've got the ripple effect. The suburbs that are close to those waterfront suburbs then become expensive. Then there's the next one beyond that. So getting affordable housing into New South Wales is actually quite difficult, because what that means is you've just got to go further out, go further away from the city. Sydney's done very well to, put in the second airport that they're doing at the moment, which will be coming online in a few years. They've decentralised Sydney CBD and really focused on building out Parramatta, which pushes the actual city and employees out to the west a bit more, so that people don't have to commute into Sydney. But even still, Sydney is very expensive and will remain so for a long time. Obviously, they've got the harbour on one side, the beach on the other side, and then the other side, there's the Blue Mountains, which makes it very difficult to find affordable land to put housing in. And like I said, Sydney's a beautiful city, but getting affordable housing in there is quite difficult, which means that people do often migrate out of Sydney and go out to, a lot of people move interstate from Sydney just for the affordability and the employment opportunities.
Mm. So where do you see the Sydney market heading? Is it more sort of just for wealthier people?
The Sydney market, there's always going to be opportunities in Sydney. A lot of people interstate cannot invest in Sydney. And so a lot of the property investment in Sydney will happen from Sydney-siders. And so myself as an investor looking at the prices in Sydney, what you can get in Sydney, you can get two of in other cities. In particular, in Melbourne has the same, if not better, fundamentals than Sydney, more infrastructure spending, better planning, and more population growth. So for me, if I can get two townhouses for the price of one townhouse in Sydney, in Melbourne, I would spread my risk across two in Melbourne. That doesn't mean that there's bad investments in Sydney. It just means that for my personal risk profile, it makes more sense to spread that capital a little bit further. Those that are buying and investing in Sydney are probably going to continue to do very well, but a lot of people can get better bang for their buck in other parts of the country.
Yeah, and you touched on it a little bit before with the accessibility due to the Blue Mountains and the space. Melbourne's got so much more space to grow into as well, right?
Well, that's right. And Melbourne really has, like I said, done a huge amount of planning. I mean, there's $130 or so billion train system that's just had sign-off that's going to be going through. It's an insane amount of money that's going into that infrastructure. And for me, yes, it is a long-term project, but it shows that there is commitment to that infrastructure, and it's like a middle ring train line that's going to connect, because often at the moment all of the train networks in Melbourne and most capital cities, to be fair, they go from the outer suburbs in and into the city, into the CBD, and then they go back out again. So there is no connection in the middle ring suburbs. So this mega railway, I guess you could call it, connects up the middle ring suburbs. So you don't have to go into the city and then back out again. You can actually go, I guess, around that middle ring. So that's a long-term project. The first stage of that, which is, I think, $20 billion or so, has just been signed off and is literally happening. These sorts of infrastructure projects, I mean, the Westgate Tunnel project, there's the airport rail link, and countless other projects that are happening in Victoria. I think it's a very good time to be here.
Yeah, awesome. Well, final question, Luke. What has been the biggest challenges you've faced while growing your portfolio?
I think the biggest challenges for me are really managing cash flow. I think that's the hardest thing for most investors, is not knowing external factors. When you're buying, I guess in my first 10 years, I was buying secondhand properties, and I was buying a lot of, I guess, problem child properties that would fall apart. I had a house once that every 3 to 6 months, the house was 60 or 70 years old at the time, and every 3 to 6 months, the property manager would call me and said the tree roots have grown back into the pipes again, because they had these big old terracotta pipes underground, like sewage pipes or whatever. Every few months, we had to send a plumber out there and go and put this machine down there and dig out all of the tree roots that had grown back in the pipe, because it blocks the pipes. Houses they were so old that there was possums getting in there, and we had to constantly go out there and look after that. Had leaks on roofs, hot water systems with problems, safety issues on properties. I guess for me, one of the biggest lessons is actually not just looking for a property that I thought was a good investment, but also understanding the numbers behind it. So one of the biggest lessons is, making sure that the property actually fits your strategy. for me, going and buying a bunch of secondhand properties really wasn't a smart decision for me. Yes, I made money on those properties ultimately, but for me, having to constantly accept a lower market rent because of the condition of those properties, in some cases, the rent was $200 or $300 a week less than a newer property.
Wow.
Because it was an older property and just wasn't in demand. Yes, it was in a great area. Yes, it was great for capital growth because of the land component. But I've been listening to all of these so-called experts telling me it's the land's the most important, the land's the most important. So I listened to that without thinking about, hey, look, cash flow is also important, right? Yes, the land is important, absolutely. But no one highlighted to me that cash flow was important as well. And so I had these properties in my portfolio that, yes, they had great land component, great location, close to the beach, close to a train station and all these things. But the cash flow was just absolutely draining my bank account, and then interest rates went up. And, it was tough for a period there where I had to, I guess, not live on 2-minute noodles, but I had to really tighten my belt on what I was doing because I hadn't really planned my cash flow. Moving forward, I've now got substantially more new properties in my portfolio, which not only give me a higher rent because more people are renting these days. So more people renting means that people are a little bit more fussy. When I was growing up, you would drive. When I was growing up, I had my bike and, ride through the streets in Perth, in Marmion, where I grew up. And you knew which ones were the rentals. People that lived in the rentals were not, the gardens looked funny, they weren't looked after, the houses looked older and run down, and you actually knew back then which ones were the rental properties in the suburb. It was quite funny to think back at that. Now, there's so many more people renting and a lot of people that are actually planning on renting for life. It's just part of the society that we're in. If you go to Europe, plenty of people just rent for life. It's not even an option. People just do not buy properties in some parts of the world. So for me, really thinking about what I did wrong was going out and buying properties because I was listening to the wrong information. I didn't fit the properties in with my long-term plan and strategy. And, looking at the properties that I'm buying now, new properties that rent really well, they have fantastic depreciation and tax benefits. And also, often if they're brand new properties, they come with a warranty. Right? So if anything goes wrong for the first 5 to 10 years, I've got, a warranty that I can claim on. It also means that I don't have to spend my money, extra money that I have to put into repairs and maintenance, right? Usually for the first 10 years of a brand new property, you've got almost zero problems. Now, there is the exception to that. You can have buildings that go wrong and water leaks and things can happen, of course, but the majority of new properties are relatively carefree and low maintenance. It means that extra money that I don't have to put into those properties, I can put into other properties. Whereas by holding the older properties that I had in the first 10 years, that extra money, $100, $200, $300 a week per property that I was putting into holding these assets could have gone into my next deposit to get my next property.
Yeah.
The other thing with the older properties is there was no tax benefits. There was no depreciation allowance available. If there was, it was very small, which means that not only am I putting money into the property, I'm not really getting any tax deductions for it either, which just slowed down my growth. What we do now at the Property Mentors, we use a software program called Augur Investor. So if you go to augurinvestor.com.au, you can actually have a look at the financials and all of the figures for any property that you're looking at buying. So when you go into that platform, it actually allows you to punch in all of the figures on you as the investor, all of your income and expenses, all of the things about you, what your interest rates are going to be, what your loan's going to be, what deposit you're putting in, but also all of the properties figures as well, so that you know what your rental income's going to be, your tax benefits, the purchase price, stamp duty, all of these things can go in there, including all your property management rates and all of your insurance costs. All of these things can go in there. What it does is actually spits out not only a cash flow figure on how much it's going to put in your pocket every week or how much it's going to cost you every week, but it'll also give you a forecast on capital growth as well. And you can change all of the variables around your capital growth rate and your interest rate. You can change your income up and down depending on a number of different scenarios. So it's a tool that I use to really plan the next purchase, my next acquisition. And for a lot of investors, doing that cash flow planning is a very straightforward system, but just doing those figures allows you to do some, I guess, planning and assumptions on what your portfolio might look like over the years ahead, just to allow you to, I guess, run a number of factors to make sure that you're not buying something that you're not going to be able to afford in 2 or 3 years' time.
Yeah, it's so important. But Luke, before we finish up, if someone's listening to this and likes the idea of a hand-holding approach to their investing. Can you briefly describe the process of working with the property mentors?
If you're looking to invest in property, whether you've already done it or if you're out there looking for a property now, or if you're just thinking about it, my suggestion would be to get in contact with one of our mentor team, have a complimentary session with them, and during that session, they'll discuss you and what your goals are, what you're looking to achieve through investing. And look, they're not trying to sell you anything. There's nothing for them to sell you. On the first call, all it is finding out about you and really for you to work out if we're a good fit for you, but also us as mentors, if we've got to work with you over the next 2 to 5 years or more, we want to make sure that you're a good fit for us as well. Working together means that we've got to really do a lot of conversations and planning, bit of goal setting, and really just working out if there's a good fit between us. So have a chat to one of the mentor team. We do have a lot of really cool information. There's a lot of videos on our YouTube channel, and we've got a learning center where people can log into and really get their education up to speed. If you need a little bit more information on finance, we've got modules that you can do on that. If you need to learn more about property selection, there's modules on that. So there's a lot of information in there that you can learn. And really my suggestion for anybody would be focus on your education before you go out there in the marketplace and invest. So there's no point in going out there and rushing to secure an investment if you don't have the education behind you first. So make sure you've got somebody by your side that's really there to help you long term. And that's what we do so well here at the Property Mentors. And I'm super proud of the team that we've got. They do a fantastic job. Look at our Google reviews. That'll tell you that we get some fantastic results for our members. Yeah, we'd love to help you through your investing journey.
Awesome. Luke, well, I appreciate you coming on once again, and I look forward to next time.
Thanks, Jacob. Take care.
If you found this episode or any of our episodes helpful, please make sure to share and leave a rating to help us reach more people on their investing journeys. And of course, subscribe to be notified when new episodes drop. Make sure to follow the podcast on Instagram at Investor Intelligence Podcast. You can find links to our other socials in the show notes, including a link to the Property Mentors weekly blog. If you're ready to get your property portfolio in shape for financial freedom, check out Luke's latest book, Property Fit. You can get yourself a copy at www.propertyfitbook.com.au.